This is BullionMax, the podcast. Hi, I'm Mark Allen, along with Sean Reynolds, the customer service manager for BullionMax. Hello, Sean.
How's it going, Mark?
It's going great. And we have with us Craig Hemte. He is the founder of the TF Metals Report. And I always get a kick out of saying what TF stands for. So, Turd Ferguson.
Right.
I've got to ask again, how did you come up with that?
Oh, it's such a long and sordid. No, it's really not. I all the way back in about 2008, maybe, I joined a website called Zero Hedge, which, excuse me, back in the day, I mean, Zero Hedge is now one of the top 30 or 40 news sites in the whole world.
Right.
Anyway, back in the day, that was just a blogspot site, if you can believe that, a Google blogspot. And I wanted to comment and interact with, back then it was mainly just proprietary, prop desk traders at investment houses in New York, talking offline. And I want to interact with those guys. And so to do so, you had to set up an account. And when you do that, you got to pick an anonymous name. And I had like a day before, maybe someone had sent me a link from a Saturday Night Live skit that had been recorded 6 or 7 years earlier of Celebrity Jeopardy. And the great Norm Macdonald was playing Burt Reynolds. And about halfway through, he changes his name to Turd Ferguson and makes Will Ferrell call him that. And so it was just on my mind. I said, okay, I'll call myself Turd Ferguson.
And in one of our last conversations, you said even your mom calls you TF now.
Yeah, she used to call me Turd too. Yeah. It just is what it is. I still, there was some real value years ago to kind of maintaining some anonymity, and I used to wear a big foam hat, when I'd make a video and stuff. And now I just don't care anymore. It just doesn't matter. I still go by TF on my site because everybody on my site.
Right.
Same thing. You pick a username. So when I record a daily podcast, which I do every day, I always say, your host Turd Ferguson here, because we're all just interacting on the site. But I'm at least now most of the time just going by Craig again.
Got it. Well, we're glad to have you here with us on BullionMax. We're going to be panning for gold. Maybe find some good gold nuggets today. Nuggets of information that we can share with our viewers. Where is, and I'll throw this out to both of you guys, where are we right now? Where is gold? Where is silver? Is it still a good time to buy?
Hey, I'll let Sean run with it. He's got his hands on the physical situation there.
Yeah, the biggest joke that we make in the store is best time to buy gold is 20 years ago and right now.
Yeah.
There was a recent peak that we hit with silver. It hit about 24.50. It's back down today as I look at the spot price right around $21. So anytime there's a nice significant dip like that, that's a good time to buy. Additionally, as I look at it, gold is at 1820. It was at about 1950 a few weeks ago. So, anytime you can get that kind of movement and take some spare dollars that you have hanging around and turn them into, precious metals that you can hold, that's a great time to buy. It's always silly to go, oh, this looks great. I'm going to cash out of this. I'm going to move some of this and that and the other thing. Okay. You have to remember the return on metals is not quite what you see from some other investments like stocks, but as a commodity, they're going to maintain their value. They're only ever going to lose so much. But the stuff that's in your investment portfolio that makes you money, don't mess with that to buy metals. Make sure it's your extra funds that you have hanging out. Make sure you turn those spare dollars that could become worthless into the commodity market. What do you think about that, Craig?
Yeah, I think you're spot on, Sean. The metals are like anything else, I guess, in the West. We all are conditioned to only want to buy stuff as it's going up, rather than wait until it comes down. You feel like you're just buying some loser after it's come back down, and everybody just wants to be on the momentum train. Like, hey, look at us. We're all, And and that's not the way it should work, right? Aren't we all we're all taught you're supposed to buy low and sell high, and but yet
That's real estate too,
right, exactly. And so really it makes me think of two things. One, if you're going to be buying precious metals, you should really be doing it on a regular basis, because nobody, I watch this stuff daily for 13 years now, but I can't be right all the time. I can't always say, oh, now's the time to stop buying and now's the time to start buying. It's impossible. The best thing you can do is just set up a program where you're taking some of your savings every month and just buying a little. And sometimes you'll buy higher, sometimes you'll buy lower, but you'll be accumulating. And the other thing that comes to mind is last year and the year before were two of the, or if not the two largest years for central bank gold buying since the late 1960s. So we're talking 50 plus years since the central banks around the world were buying gold. Okay, what exactly are they doing? Because it's not the US central bank, the Fed, that's doing it, and it's not the ECB. We're talking other countries around the world are taking their dollar reserves and they're buying gold. Well, where'd they get those dollar reserves? That's all because of foreign trade in dollars. They're exporting their whatever, their commodities, their lumber, their products that they make. The dollar is what's used to facilitate that trade. And if you have a positive balance of trade, you end up with excess dollars. Now you can do two things, just like the three of us and everybody listening can do two things. You can keep that all in dollars, put it in your bank, hold it in, in your balance of trade account at your central bank. You can buy treasury bonds, which is what a lot of central bankers do with their excess dollars. You and I can buy treasury bonds or CDs or whatever. Or you can do what the central bankers are starting to do, and that's take some of their excess savings, which is what those dollar reserves are, peel some off and buy some hard assets, some sound money.
And hard assets are a long-term game.
And protection against the current ongoing nonstop devaluation of the paper money. And so in the end, if these central bankers, and again, I'm not talking, Jerry Powell, I'm talking about other central bankers around the world. If that's what they're doing with some of their dollar reserves, then maybe everybody listening to us should consider doing the same with theirs.
Just copy what the big guys are doing.
Right.
We've always said success leaves clues. Okay, well, there you go. They have a great deal of success, and they're leaving clues by exhibiting a particular behavior. So do that same thing.
Right.
Yourself. What's good for the goose is good for the gander.
What's in the news a lot is inflation. We hear about this constantly. How is inflation affecting the price of heavy metals, of precious metals?
Well, in some regards, it's a conundrum, because gold has always been called this inflation hedge. But I've been doing this for 13 years, and I remember printing, and showing people studies that people did 10, 20 years ago, showing that, no, that's actually not, the two aren't perfectly correlated. Okay. Where gold doesn't just simply go up with inflation and then fall when inflation goes back down. Because if that was the case, what was measured inflation from, 2003 through 2011? Gold went from $300 to $1,900. Did inflation go up 600%? So it's not a direct correlation. I think the proper way to look at it is what inflation does is it crushes your buying power over time, right?
Right.
And so you've got this, that it takes more dollars or more whatever to buy the same amount of goods. And that's essentially what it does to gold too. It takes more and more dollars to buy the same amount of gold. And so in a sense, it is a hedge, but I think the bigger picture is, where is that inflation coming from? What is it tied to? The central bankers who are in charge of printing all of this cash that is the root cause of it all, driven by the demands of the politicians who need the funds. They're never going to come out and say, oh yeah, it's our fault. They're always going to deflect off and say, oh, it's a supply chain. Of course, that's what it was. And maybe there's some tertiary or even secondary impacts from stuff like that. At the end of the day, if you've got more dollars chasing even just a finite amount of goods, the price goes up. And that's what's been happening.
Yeah, I think inherent in the gold being a hedge is the assumption that you're going to buy it and hold it. And over time, that's how you beat inflation. Right. But it is by no means just because you purchased it now, it's going to have an immediate impact. And I think people need to realize that it assumes you're going to hold it.
Right.
You know, I went to the market the other day, and I've been buying a certain brand of cookies, Tate's chocolate chip cookies, and I've been paying, and they're really good. Okay, there's a free plug.
Are you paid to say that, Mark?
No, not at all.
Oh, okay.
It was, and they were like $5.50 or something like that. They're now $6.49.
Yeah.
And so, you know, we have to decide: do we eat these every night or not? And you see food prices and everything going up, but the inflation that we have today is different from, say, the inflation during the Carter administration. We've talked to some people. We had a guest a few months ago who said that the inflation is actually linked to the supply chain due to the pandemic. Any thoughts on that? That this inflation is not the traditional inflation?
And that explains why it's continuing now.
Yeah,
that's what I'm saying. I think if you're in the mood or to try to deflect it away from the root cause for whatever reason, then knock yourself out. And I suppose that's from back in 2021. You could make the case that the backlog at the port of Long Beach and stuff like that had something to help move it along. But that's not the root cause. The root cause is the $4 trillion that was created by the Fed at the demands of the politicians back in 20 into 21, and all of that cash got flooded out, not just simply to the banks, like they did in 2008, where they were buying the crap, worthless securities from Bank of America and the like, and replacing it with actual cash, which kind of quarantined it a little bit. This time it was unemployment checks and stimulus checks, and the hell was that program called where if you just kept your business open, they gave you 10 grand, remember all that? And it's all that cash got out, and it starts again chasing either a reduced amount of goods or, at best, maybe a finite amount of goods, and inflation gets out of control. And the inputs cost, think of the war last year and what happened with grain prices, because all of a sudden Ukraine's out of action. All these things contributed. But at the primary root cause is central bank. Just money printing, just all this cash. Okay, so why are they doing that? Because it takes cash to service the existing debt that's already been accumulated. The disaster that these central bankers are trying to avoid is that there's $31 trillion worth of already existing debt, if you want to go by that number, that needs to be serviced. They've got to pay the interest on that. And then when it matures, then you got to reissue it, and this is, this kind of exponential end game. And if you don't constantly grow the money supply, then how are you going to service that debt? And then the whole thing begins to implode on itself
and collapse.
Right.
You talk on the website, which we have up here during our conversation, the Keynesian experiment. I think I'm pronouncing that correctly. Can you explain what that is? Because that sounds like what you're talking about, the fact that we're spending so much money that we don't have.
Right, exactly. And that's why it's actually a folly of the Republican politicians in particular do this, talk about, we got to curtail spending and balance a budget.
That always goes up under Republicans.
And it's not going to, if they tried to do that, okay, if they tried to go back to a balanced budget, again, the liquidity would collapse. And you still have this $31 trillion of debt out there that has to be serviced. And so they have to keep running these deficits, and the deficits have to keep getting larger, just simply so that they can come up with the new dollars all the time to service all of the existing debt. I mean, I remember, geez, when I was in college and wrapping up my economics degree, I had to read a book by a guy who's still around. The Case Schiller, what's his name? Anyway, I can't remember his first name, Schiller. Anyway, wrote this book about how real is the federal deficit. And he was trying to make a case, you know, that in real terms, inflation terms and all this kind of stuff. But back then, you guys remember Reagan and the Republicans and the Congress and everybody else were chastised for $250 billion in annual deficit. And now we often do that in a month. Okay,
Yeah.
so give
It's
it
been
another.
normalized, hasn't it? The big numbers get bigger, and you go, well, okay, then if that's what it costs.
And that's
But
the
at the same-
and that's
But
that
at the
Keynesian
same time,
experiment.
I'm sorry, Craig, but at the same time, in recent history, we have had a balanced budget, and that was done by a Democrat. But
It was, again, though, what your recent history, though, Mark, is
Right.
1998,
yeah, that's
Yeah, what was-
I
and what
remember
was-
that year.
right? What was the size of the federal deficit total debt at that point? About $4 trillion, maybe? And the
Yeah.
U.S. economy is buzzing along maybe back then at about $20 trillion a year.
Yeah,
It's
yeah,
a
you
totally
have to
different
remember
animal.
there's a difference between the debt and the budget.
Right. So,
Right?
I mean,
And I
but
think people have a hard time differentiating between the two. It's like they assume we didn't have the national debt. Oh my God, Clinton was so amazing. No, we
Right.
balanced the budget. And I think it was just for like a quarter or something like that. I mean, it's a great figure to hit, don't get me wrong, but still, there still was that debt.
and again, that gets back to what Mark was asking about the end of the Keynesian experiment. John Maynard Keynes being a famous economist from the Depression era, World War II era, that proposed that a debt-based system would be better than a sound money system. You know, coming out of the Depression, you know, and everybody thought that having the central bank would be the answer 100 years ago and all this kind of stuff. Well, the problem is a debt-based system, really by definition, grows exponentially because you have to continually grow the debt to continually create the more money supply that continually feeds that debt and services that debt. And that's where we're getting into this terminal phase, because it takes so much new cash now to just simply service the existing debt. And that gets to the kind of the fallacy of this notion that, oh, the Fed is just going to keep hiking rates, you know, and that what's a 6-month U.S. Treasury bill right now is 5%. The 2-year note is approaching 5%. Remember, they managed that debt service cost all through the first 20 years of this decade by lowering interest rates so that the debt could grow, but the interest rate went down, and they shortened the maturity so that everything's in there with about a 4-year maturity at, 2%. And if it's 2% on 20 trillion dollars back in the day, okay, we can manage that. That's only 400 billion. But now if the rate is 5% on 30 trillion, now that's $1.5 trillion a year. And that exceeds the military budget. That exceeds, maybe that's getting really close to what we're taking in. The government takes in revenue from taxation. I mean, so if interest rates keep going up, and if the total amount of debt that has to be serviced keeps going up, eventually you are paying more just to service the debt than the government's even taking in during the current existing tax structure.
That really is the deficit. That truly is deficit spending.
Right.
Feels
Yeah.
like
Or
a very old
monetizing,
term.
eventually
Yeah.
monetizing the debt. Yeah. So where does the money come from? So that's what, so anyway, the idea is eventually this all collapses. And whether that happens next year or 5 years from now, whatever, my inclination is that since the great financial crisis in 2008, where the paradigm changed and the Fed said, we'll just monetize this stuff whenever we have to. And we've gone from a $1 trillion Fed balance sheet to a $9 trillion Fed balance sheet. The Fed has been forced to make a choice a couple of times now between playing this game, this rhetorical game of, well, we are responsible. And all those QE programs were just one-offs. And now we're going to draw the balance sheet down and normalize interest rates. And then as soon as the economy begins to fail, throw that out the window and start printing again. And that's the choice they'll make again this year.
And that's what I don't quite get, because it appears, at least on some level, that our economy is booming. I went to the mall the other day.
Yeah.
And it was packed. I couldn't find a place to park.
Yeah.
People are walking out with bags of stuff.
Right.
I don't know if they're putting it on credit cards, if they are, spending more because they can.
Right.
There's still tons and tons of signage, at least here in Southern California, in the LA area, hiring now. And that's at department stores, restaurants. We need workers, and there aren't enough to go around. How does this affect the economy and related back to precious metals?
Well, let's start with the worker part. I mean, we've all seen that. I mean, where I live, I can go out to dinner and half the restaurant might be closed off because they can't get service. It's like, where do these people go?
Yeah.
Did the rapture happen and I didn't get taken? Which I wouldn't necessarily be surprising.
You were left behind, Craig. You're left behind.
But no, and so what a lot of people are waiting for, what a lot of economists are waiting for, is kind of a wage price spiral where, well, and you can kind of see this. Was it just yesterday? McDonald's or somebody, or Walmart maybe, was talking about, they're at $7.50 minimum wage. We're paying at least $18 to hire people. Right. And so now again, $18 an hour doesn't do much for you, but that to get people to work, their corporations are paying more to people, which is more money in a bigger picture, in a sense, in your pocket, so you can go out and spend it. The only thing, though, that the mark you've got to watch is I think it's easy to make an assumption when you see the full parking lot and think that these people can all afford to buy that stuff just like you can. If you dig in a little deeper, like if you go to, and the Fed will put out data on household debt and that sort of thing, it's higher than it's ever been. In fact, credit card rates, I mean, think of the pillaging taking place here. Credit card rates are the highest they've ever been.
30%.
It's outrageous.
It is. It's and
I mean, it's theft.
And some of the credit card companies are making bank. They're making a lot of money.
Outrageous. And then, but if you can also drill down, and like Visa will put out stats. They just transact, right? They only just do all the transactions, and the amount of stuff that's getting done with debit cards versus credit cards is going like this.
Sure.
Okay. And so I think a lot of people they're out shopping, they're buying new stuff, maybe because they have to. But it's all going on credit cards. Right? And now that's a blanket statement, but that's how a lot of folks are doing it, is they are just trying to keep it. It's like the jobs report. Remember the jobs report 3 weeks ago that just crashed gold $100 in 2 days because it was 517,000 jobs and how robust it was. Do you know of the 517,000 jobs, 624,000 were part-time? Okay, we can talk all about the seasonal adjustments and all the other statistical games that the Bureau of Labor Statistics plays, but it's all part-time jobs. And what is happening under the surface that somehow is reported as good news? You see these layoffs, whether they're in Silicon Valley and tech companies or anywhere, these layoffs, companies that are preparing for hard times ahead, and they just got to start landing, and they're reluctant to do it because then they don't know if they're going to get people to come back, obviously. Right. But they start laying people off. So you say you're a regular guy and you're making $80,000 a year at whatever your job is, and you got PTO and you got benefits and it's a good job, and then you get canned. Well, you still got mouths to feed. So what do? You take that Walmart job at $18. You maybe drive a little Uber on the weekends, right?
Right.
And what's another one that you could do? You could also
you be a shipped shopper, gig economy,
right.
Uber.
Okay, so you lose your one job, your good job. You replace it out of desperation with 3 part-time jobs. And do you know that then the Bureau of Labor Statistics counts that as a net gain of 2 jobs?
Yeah.
Come on.
And you probably don't have health insurance or other benefits.
Or
Right.
any benefits. Yeah.
Right.
exactly.
And now you're buying crap on credit cards that you didn't have to do before. And all of a sudden consumer credit is going. I mean, all these things. So anyway, I find it all very maddening, as you can tell.
Yes.
And what's hard and I've been writing about this all week on my site, because I write a post every morning summarizing the news, and then I do a podcast every afternoon, letting, so that people can live their lives. Let me deal with this crap every day. But letting people know what's gone on. And I spent a lot of time this week trying to, I guess I do this because I sense it myself. And so I figure if I'm feeling this way, I bet the people on my site feel this way. Trying to not get distracted by like almost a tyranny of headlines that the news media and social media comes at you, trying to get your attention every single day with a news flash that this is the most important news has happened in decades. When really it's just a data point, or some Fed goon will come out and, pontificate about something that they've all said 100 times before. Oh my God, did you hear what Goon Williams had to say? Oh, it's all over for this and that. Really have to, it's just vital as an investor, not even just as a precious metal investor, to remain focused on history, that Keynesian experiment, the math, okay, and where this is all headed. Block out, all of all the noise that comes at you so fast, and just try to remember where this is all headed in the end, and educate yourself, think for yourself, be objective, not be afraid to be objective, and think for yourself, and then kind of plan accordingly,
Do you think,
for what's coming.
we only have a few minutes left. Do you think that the Fed will raise interest rates yet again? Or are they going to hold it?
The market's pricing that in. We're recording this on the 24th. We've gone from Powell telling us that there was maybe going to be one more rate hike in December, and then in January giving us that rate hike and saying, yeah, there's probably one more, and then we're going to wait and see what the data shows. This data in the last 3 weeks has supposedly been so strong that now the market is pricing in 3 more. That's frustrating in the short term, because you think, oh God, now it's going to take even longer, for the pivot and the pause, and then here we go. But it's actually, if you really want a rocket ride, if you really want to have some fun, it's actually beneficial for all of us, because the Fed has no idea the damage that they're currently doing. I mean, all of this stuff has a lagging effect. You can't just raise Fed funds and watch it do to mortgage rates. I mean, we just saw it with 30 year over year. Existing home sales down 37%.
Yeah.
Biggest drop ever.
Yeah.
Okay. Well, there's a lagging effect to all your rate hikes, right? Well, what it's going to be this year? What are home sales going to do? They don't know. And they all sit there, these ivory tower academics, guys like Bullard in St. Louis, who's on CNBC again this morning, has never had a job that wasn't at the Fed.
Yeah.
And so he can wax and pontificate and talk about their models and how smart they are and how much credibility they have. They do not have a model for taking the Fed funds rate from 0 to 5% in 15 months. They've never done this before. So they can talk about how, they've got all this credibility and all this kind of stuff. They have no idea what the impact is going to be.
I'm sorry.
That's okay.
Would you, I keep, I think of things and I have to get it out.
Go ahead.
And
sure.
that is, should the Feds have left the interest rates at 0 or, 1%, 2%?
They couldn't do that just because, remember what were we maximizing annualized, even by CPI, 9% or something last summer, right? So they've got to do something. Yeah, people gone, if it'd gone to 15%, can you imagine the political uproar ahead of the midterms, and all that kind of stuff? So they've got to spin the dials. The problem is, again, it is so out of control. And again, the last thing that they can afford is some crushing recession where people are out of work and tax, like we were talking about earlier, tax revenues at all levels begin to collapse. Because nobody's making any money and corporations aren't making any money and all this kind of stuff. And now you need even more money to try to service the debt, and inflation keeps going up. So interest rates keep going. I mean, it's a disaster they're trying to forestall.
I would not want to be the Fed chairman. I mean, it's a lose-lose.
Isn't that funny? I remember joking when he decided he'd take a second term. I was like, this guy's either a masochist or an egomaniac. Why you'd want that job?
Yeah.
Other than the fact that everybody praises you as this demigod, why you'd want that job? I have no idea, because it's not a winnable,
It's
tenable
attention, but it's not good
situation.
attention.
Yeah.
Yeah, but he likes it. They all like the attention. I mean, all these guys, they all run out. Anyway, I'm sorry, I'm going on and on.
No, I
No
get
such
it.
They're gonna-
thing as
Listen,
bad
Craig,
press,
we're
No
out
such
of,
thing as bad
we are-
press. Just talk about me, okay?
The only thing that I wrap up with is just that thought that the longer they keep doing this, and they're going to keep doing it, the economic damage is going to be worse. The quicker things are going to go in the tank. And remember, they held off hiking last year because it's transitory, right? And they were still doing QE even though inflation was accelerating. And then what they had to do, 75 basis points 3 times in a row, the big shock, right? Because they waited too long. Think of that process in reverse. They're going to wait too long to stop hiking. Okay. Regardless of what inflation is, they're already talking about saying maybe 4% inflation is okay, or 3, not 2. And so what are they going to do? The economy is going to be so horrible by later this year. They're going to start cutting in the same direction, 75 basis points cuts, that kind of thing, trying to forestall some kind of economic collapse. Can you imagine do you think gold and silver will be slogging around at $1,800 when they're cutting 75 basis points? Yeah.
what do you
Probably
think,
not.
where do you think it'll go?
Well, that's all part of the fun, right? You think
Yeah.
the next big run. When I wrote my forecast back in January, usually when you make a new high in anything, Mark, whether it's a stock or a commodity, you make a new all-time high, that generates enough momentum and excitement and headlines that then you run about 10%. So I still think at some point later this year, we could see 2,300 in gold prices, above 2,100 by 10% up 23. Then as this really gets going next year, extend another 20% beyond that.
Wow.
And then, and what does that do to mining shares? And what does that do to the supply of gold as suddenly everybody wants it? All these things are on the table as we get later into this year.
And real quick, you're a big silver guy.
Yeah.
Right? Silver's
Yeah.
going to go up too?
Got lots of it. Yes.
Yeah.
Absolutely. If for silver, one thing we didn't talk about this year, watch copper and the other base metals, because silver is more of an industrial metal these days.
Mm-hmm.
And global inventories of all those base metals, if you sum up what's held in London and Shanghai and all these other places around the world, global inventories of those industrial metals is really falling fast and has been for about the last 5 to 8 years. We could get into some real dicey situations, particularly in copper. And there's a long-term relationship between copper and silver. Again, for a number of reasons. Copper's been in a trading range like silver has for the last 2.5 years. If copper starts to break out and silver has yet to break out, that might be a sign silver's about ready to blast forward too.
Got it. Craig, thank you. Will you come back soon?
No, this is it. I'm not doing this again.
Been good to know you.
Yeah, sure
Got it.
was fun. No, and look, and for everybody listening, I've got a handful of precious metals dealers that I associate myself with that I think are reputable, that do a great job, have great service. And again, the last thing I'm going to do is tell people on my site, to go, hey, if you need some metal, go here, and then have them drop the ball. So I'm happy to associate myself with you guys, as kind of a smaller growing business. I know you're doing a great job. And just if I can kind of give everybody the encouragement, if you found this podcast and you're a precious metals enthusiast, stacker, make sure you keep BullionMax on your radar every time you're in there looking for some metal. You guys do a great job.
Hey, thank you, Craig.
Thank
We
you.
really appreciate that. And thank you, Sean, because you're the guy who does a great job.
Right. He does.
Hey, getting it done, one customer at a time.
Hey, that's true. Well, thank you both for joining us here on BullionMax, the podcast. We will be back very soon, and we'll continue our conversation about precious metals. I'm Mark Allen.
Don't forget to subscribe.
Always do that. Always forget. Yeah, please subscribe. I'm Mark Allen for Sean Reynolds and TF. We'll see you next time. Bye-bye for now.